Hey everyone, welcome in to another daily editorial here on the KE Report, chatting with Craig Hemke, and we're going to be talking about gold, silver, their runs from last week, as well as the stocks following along. Gold poking its head back above 2,400. Silver peaked above $31. Now it's pretty much right back to that level. And again, the stocks, a wide range of the precious metals stocks, really moved higher. Craig is the founder and editor of TF Metals Report. We will post a link to his website in the show notes. Now, Craig, a lot of the talk last week with the markets rallying and precious metals rallying was all about inflation data and more or less the markets pricing in a Fed rate cut. Finally, that rate cut that we've been waiting for in September. Again, a lot rallied, but since we're focusing on the precious metals, gold and silver, in your eyes, was this the key catalyst that moved the metals prices higher last week?
Yeah, hi guys. I recall last Monday we started the week rather poorly. Gold was down $35 or something like that. We have an old adage. We have a number of them actually at TFMR. One of them is it's not how you begin the week that matters, it's how you end it. Because you get the weekly chart, that sort of thing that is so important. We ended the week pretty well with a big rally on Thursday. You can trace it to the CPI actually coming in negative, first negative print in 3 or 4 years. And then that allowed for an adjustment up of rate cut expectations. And it's not so much that there's just one cut coming. The expectations now are for, and markets seem to be pricing in two for both September and maybe again in December. I almost wonder if it won't be more like three, the way the U.S. economy is apparently slowing. But nonetheless, that's the notion that really helped push up gold last week. Silver, though, was down last week. So even though rates were down, the dollar was down, silver was down too. So that made for kind of an interesting dichotomy. But gold was up 1% last week, a great week, something like 5% in the GDX. And we can talk about that too. But again, we're kind of back into this. There was, as we began the year, everybody was thinking 6 or 7 rate cuts, and that evaporated and went to 0. And now we're finally getting close enough to where I think you can rationally expect, and that's what the market is pricing in, at least 2.
Well, imagine that. We went from overexcited to underexcited to a baseline of reality all within a year and a half on the rate cuts. Do you think, though, that with the expectations that people had at the end of last year, Craig, because they were expecting 6 to 7, and they were expecting a rate cutting cycle where it was going to go down 100 to 150 basis points, if we get 1 or even 2, or even maybe 3, like you mentioned, does it really do enough to really blast things up to the next level, not just in precious metals, but same thing in the general markets? It seems like there was so much expectation for a big cycle of these cuts and a meaningful move that I don't know that a 25 or 50 basis point move down in interest rates is really going to do much.
And to your point, Shad, you think back to when this majority of the rally so far this year occurred. It's been March and April. And gold had traded downward to about $2,000 an ounce. And then in the last week of February and early March, it began to break out. Goon Waller had said some things about future QE, and boom, we had a big breakout on the monthly chart and got up about 2,100. Then gold just took off with momentum, even though these rate cut expectations were coming in, even though the dollar index was rallying in the first quarter. It rallied 3 or 4%. And so why did gold go up? I don't know if we ever really got to the bottom of that, because it certainly wasn't rate cut expectations at that point. Was it just a surge of momentum with an obvious breakout on the chart? Maybe. So now going forward, here we are. We've weathered this storm, if you will, of going from all these expected monetary easing this year to very little monetary easing this year, and gold's still up 15% year to date. So what happens when they actually do start easing, I guess, cuts to the heart of your question. I guess the most logical thing is you fall back on what we've seen in the past. And Ronnie Sturfla had a chart last week from his In Gold We Trust report that I saw on Twitter. And he just had the last 3 monetary easing cycles by the Fed have been conducive to higher gold prices, 3 in a row. So whether we can relate tit for tat, 25 basis points means X amount of dollars, that kind of thing. But I think in general, from a just investment point of view, from an asset allocation point of view, when we get into a regime of rate cuts and easing monetary policy, it just gets more, for again, this traditional sense that, well, maybe we ought to own some gold here. And with the precious metals markets and mining shares being so small, a little bit of money can make a big difference. So I don't know if that's a long answer to a short question, Shad. I don't know if we can draw a line from rate cuts directly to a rising price in the back half of this year, but you can see where it's all kind of connected and can provide fuel for that next stage of the rally.
Well, that is true, right? Rate cuts, especially if it's a cycle of rate cuts, that will bring some money off the sidelines that is sitting in these higher yielding money markets. But one rate cut, that might not be enough to bring that flood of money in. But Craig, how do you compare that to kind of that one universal chart that we've talked about where markets go up as well when we do have consistent rate cuts? Even look at the small caps. They started to break out last week. Again, it seemed like very much on the back of these rate cutting expectations. So how are you looking at what you've even termed that one universal chart for markets?
Yeah, in a way, it's a sense of liquidity. What's the term they use? Just general market conditions of loosening, and the idea that, well, okay, monetary conditions are really loose, and so therefore these risk assets tend to perform better. And that's what makes them all kind of look the same sometimes on a chart or on a day where everything seems to be going in the same direction because, oh, look, monetary conditions are getting looser. So as you look at the one universal chart going forward, I mean, this has been kind of the modus operandi, if you will, of these markets now for over a decade. If the Austrians call it the crack-up boom, that eventually they're just printing so much money and keeping monetary conditions so loose that part of that cash makes it into the investment markets, and they all just kind of go up in tandem. They all crack up together. So again, it's always going to vary from day to day, even sometimes week to week. It's like we've discussed here, the pretty obvious correlation between silver and the GDX. It doesn't mean every single day, like last week, silver was down, but the GDX was up. So it doesn't mean every single day it's going to track each other, but you can see where clearly over time they do. And I would think over time, Corey, that you get that one universal chart idea based off of and correlating that with monetary conditions will probably continue to correlate pretty closely.
Well, Craig, let's talk about silver because you mentioned that it was down last week, but really it was up all week until Friday. It was outperforming gold all week, and we had guests on the show talking about silver's outperformance over gold, and the silver stocks were ratcheting higher, but then silver kind of fell apart on Friday, unlike gold. Do you have any thoughts on the open interest in silver or the open interest in gold as far as where that selling pressure came from?
Well, I mean, anybody can look at the chart. I put it on Twitter last week and again today. 5 of the last 6 trading days, on an hourly chart, there has been a really big red candle in either the 10 o'clock Eastern or 11 o'clock Eastern hour, 5 out of the last 6. So a lot of this big selling is paper COMEX oriented. So you can say whatever you want about that, but that's the timing that it's been happening. And then you get these kind of rallies back during Shanghai or during London, and then boom, you get another one 10 or 11 o'clock the next day on New York. I think in a bigger picture though, and I can't remember if we talked about this last week, I think what's important for silver in this moment is the breakout that it has finally attained on the weekly chart. You could say it's on the monthly chart if you want as well. If I take you guys back to Halloween last year, gold was trying to post a monthly close above $2,000 on the spot chart for the first time ever. 30th and the 30th, I think it was Monday the 30th of October and Tuesday the 31st. It was briefly above 2,000, and we're like, okay, and then it fell back and didn't get it done. But it did get it done in November. Last trading day of November, spot gold closes above $2,000 for the first time on a monthly basis. Then it held that into December. So now you got 2 months in a row, but you also had the first time on the quarterly chart that gold had closed above $2,000 an ounce. That's the kind of stuff that, at least in my mind, gets the those home office accounts and the high net worth people and the hedge funds, they notice those kind of longer term secular trends. And what gold has done in the 6 months since. Okay, so what happened in silver at the end of June? Not only had it broken out in May and then continued that into June above its old range, above 28, 29, it posted that breakout at the end of June above 29, which, again, not an all-time high, but out of its range, just like gold had done at the end of December. So now does silver get the same attention from some of these high net worth and hedge fund people to kind of drive it forward like the way gold caught a bid in the first quarter and then carried it into April and May? Maybe. And so I'm kind of, in a bigger picture, that's what I'm more interested in silver is demand, not only for the physical, but for the derivative too.
Craig, let's talk about that demand for gold then, because you were bringing up to us before we were recording some of the moves in the CoT reports, also correlating those back to earlier this year, some of the increase in open interest. Look, I think an increase in open interest is always good for these metals. It does show a bit more interest broadly. But what did you notice just in these recent reports?
Well, I noticed this months ago when gold first took off. When I mentioned the thing earlier with the Fed Goon Waller on, Friday, March the 1st, indicating that they were kind of clearing the decks for future QE, and gold shot higher, $30, and finished that week like 2067, or 2087 maybe on a breakout. And then the next week it moved up $100. And so during that period from, let's call it Wednesday, February 28th, and then Thursday the 29th, March the 1st, Friday, and then the first 3 days of that next week as gold is surging and breaking out, going basically from 2050 to 2100 in 6 days. So maybe not that big, but close to that. Open interest exploded then. Open interest in COMEX gold back in that period, that 6-day period, went up substantially. I'm just looking up the numbers myself to make sure I get it right. In 6 days, again, February 28th through March the 7th, open interest went up by 95,000 contracts, or about 23%. It was a huge move, and price rallied almost 6% in those 6 days. Well, we just went through from July the 2nd to last Thursday, again, 6 trading days. The U.S. was closed in there on Thursday the 4th. Open interest moved up by 22%, and price rallied about 4%. Now, again, it's not the exact same situation. You're not getting that breakout like we had, and I mentioned earlier, at March the 1st. Nonetheless, though, a pickup of open interest, as you said, Corey, is typically indicative of people getting excited, new money coming in. The old adage when I was a stockbroker 30 some odd years ago was that volume precedes price. And people know this that trade the mining shares. You'll go long periods of time where a stock doesn't do anything and it has no volume because nobody cares. It just sits there. But a lot of times before a big move, you get volume picking up first. You get people, oh, okay, there's something here. Maybe initially you get sellers. Hey, look, it's up a little bit. I'm finally going to get out of this dog I've been in forever. But eventually that interest continues. Then price moves up. And so what I wrote back in March was that in this case, volume is contract volume, open interest volume. And again, that interest of people getting excited about gold again maybe would then drive price higher. And that, again, that's what then happened after March the, whatever I said, that was 7th. Over the next 5 weeks, gold rallied another 12%. So I'm not saying it's not the identical situation in terms of the chart and everything else that goes with it, because there's a lot of things on a daily basis that impact gold. But at least from an interest and open interest standpoint, pretty striking similarities. We are entering, as we discussed last week, a very strong seasonal period for gold. August is typically the second best month of the year. As we mentioned earlier, we're getting close to the Fed starting to talk about rate cuts again. So you can kind of paint a background that might be positive for gold too. So, put it all together. Yeah, maybe, you know what? Maybe we are set for a late summer rally. I don't think neither you two nor me would have a problem if we did. It'd be perfectly fine if we did.
Yeah, Craig, I don't think anybody listening would have a problem if we had a late summer rally, but let's translate it over the moves in gold and silver into the mining stocks. GDX, what we can say is it made a new 52-week high and has at least blasted up out of the danger zone it was in for a while. Do you think that there is more interest coming into the mining stocks? Because we can't say that the volumes there are as encouraging as we've seen in the metals, but the price move has been.
Yeah, volume is just going to probably continue to be like such an overlooked sector. And we've also talked before about needing almost kind of a mental rotation from asset allocators out of growth into more value, because at this point, the precious metals miners with their dividends and stuff are probably perceived more as value, almost like in the old days, a utility company, it paid a 6% dividend. You're like, yeah, it's a value stock. You need that kind of rotation out of growth into value. I'll tell you one more thing, though, that might catch the eye. And again, think of somebody that manages a couple $1 billion and you're trying to get ahead of things and you're trying to make a positive returns. You're a hedge fund. You get your 2 and your 20, right? You're going to charge 2% and you get 20% of the gains. So, if you can get some gains, as a hedge fund manager, you're going to make a boatload of money. So you got to get those gains. What catches your eye? A sector that's taking off. Again, not on a daily chart, maybe not even on the weekly chart, but on the monthly or the quarterly. I'd invite everybody, go to your favorite charting service and pull up a chart of the GDX as a proxy for the sector. At least go back to 2011 when the GDX was at its all-time high. Start a trend line there and connect it down through the highs of 2016 and then later to the highs of 2020. And you've got a straight line. They connect perfectly. And then extend it on down. Then build yourself a lower boundary of that pennant from the lows of early 2016 and extend it back up. And you make yourself a little pennant. You know what happened last week? Now we're only on the weekly chart. Let's see if we can do this on a monthly chart. But on last week, we broke out to the upside. So again, long-term secular trend. You're managing big money and you see that breakout in a kind of a value sector, pays a healthy dividend, you might start allocating some money to that sector. Now, all of a sudden, the sector's not dead. Maybe we'll relate this back to what we just said a few minutes. Let's watch, as you said, let's watch the daily trading volume in some of these shares. It's starting to pick up. But if you start seeing even more trading volume, where it's trading 50% more than it was, a couple months ago, that might be your confirmation. Let's watch that monthly close in the GDX. See if it can stay up around, at least above 37, near 38. That might be enough to really kickstart things into the back half of the year.
Craig, it's so true what you said about momentum too, right? As much as people want to say you can be a contrarian, try to pick the bottom, buy when everything's hated. Quite frankly, big money follows big trends. And if we have a big trend here, that is what brings in more money. There's no secret around it. It makes sectors bigger. And it helps people make money in the sector, which has been fairly difficult to do for the longer-term investor. So, hey, hopefully this all just keeps on going in that direction because it's nice. Hopefully everybody's making money. It's not just this sector that needs to go higher. If other sectors go higher, well, then there's more money out there to rotate around as well. But right now, encouraging to see some of those closes recently and also just to see how well the shares and the metals have done starting off the second half of this year. We'll chat with you again next week, Craig. I always appreciate you taking a look into those CoT reports as well. Hope you have a great rest of your week there, Craig.
Thanks, guys.